How crypto works, Bitcoin, altcoins, and proof of stake. If you heard about crypto before, you have no idea how it works. Let's go ahead and discuss the blockchain technology, proof of stake, Bitcoin, and altcoins. In addition, you'll learn about proof of stake, the mechanism behind each cryptocurrency, which is backed by a digital signature. Hopefully, this information will help you understand the crypto nuances and its applications. We'll touch on the importance of research and how you can maximize your return on your investment. Blockchain technology. If you're interested in crypto blockchain technology, there's a key to understanding this exciting new field. The basis principles of blockchain technology are simple. Distributed ledgers allow people to share, store, and transfer digital assets. Blockchain can be private or public. Private blockchains are best for organizations and businesses that want to maintain a private network without limiting other parties access to their data. They can also be governed by a single entity. The technology makes it possible to move money and goods from one place to another securely. In addition to enabling payment transactions, blockchains can be used to the transfer of confidential information. By making these transactions private, blockchain users can avoid the risk of fraudulent activity, and it is important to share your information with a large amount of people, and it's a good idea to protect your own personal information with these systems. Unlike other methods of digital currency, blockchain make it easier to protect, while private information is kept private and keep it secure. The decentralized network is another benefit of blockchain technology. This means that the decisions made on a blockchain are by consensus instead of central authorities. The decentralization process also ensures that there is no single point of failure. A typical financial system requires the services of third parties, such as banks and exchanges, by eliminating the need for such intermediaries. Blockchain technology helps to lower the cost and increase transparency of transactions. Blockchain systems can return the fees to miners and stakers, which in turn helps the network grow. Bitcoin is extremely volatile, and the price changes dramatically depending on what happens in the cryptocurrency. Proof of stake and proof of stake cryptocurrency. The proof of stake cryptocurrency model is essentially one that replaces miners and validators. These participants purchase cryptocurrencies and stake it in smart contracts to form a chain. They then receive rewards based on the number of blocks they create, and if they have the right amount of stakes, they can even create new currency units. In this system, validators do not have to be real people. They can be any computer that sends information and receives data. Proponents of the proof of stake have argued that this method is more democratic than proof of work because anyone with tokens can participate in the process of validating transactions. Proof of stake also cuts out the highly complex cryptography puzzles. As cryptocurrency gained its wider adoption, the environmental impact of proof of work protocols became a topic of analysts. However, proof of stake reduces the burden on the environmental and it makes a more democratic system. Proponents of proof of work argue that proof of stake encourages people's good behavior and rewards actors. While this may appear to be a negative, it does make it difficult for malicious actors to take advantage of the system. With proof of stake, legitimate users are rewarded in crypto, reducing the chances of fraud. However, some people disagree. Many people are unaware that proof of work has many benefits. Bitcoin. How does Bitcoin work? Bitcoin is a decentralized cryptocurrency with no central authority or government. It's easy to store, vault it, and value it, and exchange it for goods and services. It's also secure, portable, divisible, and limited in supply, making it a perfect medium for a small-scale transaction set, so much that you can actually replace, potentially, the cryptocurrencies that are existing. That's why Bitcoin is the most popular cryptocurrency. The simplest way to buy Bitcoin is to use an online exchange like Coinbase. These exchanges store Bitcoin in your private and public keys, which you can use to send and receive payments. Because Bitcoin uses a distributed network of computers, there's no central authority. This means that every single transaction can be verified by anyone else. The software automatically rejects transactions that do not meet the rules. Every 10 minutes, Bitcoin transactions are batched into blocks. Each block is added to a long chain containing all previous transactions. This process is known as mining. When someone successfully mines a block, they receive a small amount of money called Bitcoin. The creator of Bitcoin, an anonymous person with no real identity, released a white paper in 2008. The paper outlined the basic structure of the cryptocurrency, its features, and its use as a cryptocurrency. Also to find a launch date, and since then, the digital currency has become one of the most popular forms of payment on the internet. This has led to a politification of businesses, governments, and non-government organizations that use it. There are more than 100,000 Bitcoin exchanges worldwide. Altcoin. If you're wondering how crypto works, you've probably heard of Bitcoin. But what exactly are altcoins? Simple definition that they are cryptocurrencies that share the same underlying principle as Bitcoin. A blockchain is incorruptible and records transactions based on consensus. Like Bitcoin, altcoins have similar uses and strive to be the next big thing in digital transactions. We're going to talk about some of the key differences between Bitcoin and altcoin. The main difference between Bitcoin and altcoin is the fact that each altcoin operates similarly. Both use private keys and send payments. They are permanently recorded on a blockchain, which is secured by mathematical proofs that verify each transaction into a block. These proofs are what make altcoins attractive to investors. You can find more information about these currencies on NerdWallet. Just make sure you use some of the information to really help you make informed decisions on how altcoin works. The first major altcoin was Namecoin, which has since gone to become the most popular cryptocurrency. Since then, more than 900 altcoins have been released. All of them use the same blockchain, but have varying features and methods of consensus. Some are designed to provide more value and functionality than the processors. In addition to these features, many of them use blockchain technology and have developed smart contracts to ensure that the transactions are verified. Volatility. The volatility in crypto prices is largely influenced by supply and demand. While fiat currencies are backed by physical assets, cryptocurrencies have no such physical backing. Because of this, the price of cryptocurrencies is determined solely by the demand and supply. As such, price swings can be highly unpredictable. In particular, volatility is exacerbated in case of Bitcoin, which experienced a dramatic rise in trading volume around 2020. Because of this, cryptocurrency prices are highly susceptible to market manipulation since, selling off their holdings when prices rise. The best way to handle volatility in cryptocurrency is to diversify your portfolio and keep your cash ready to invest when unexpected dips happen. It's always good to choose a coin backed by different assets such as dollars or gold. This will help you minimize volatility and limit the amount of money that you lose. However, if you're investing for long-term run, you don't have to worry about short-term volatility since the price of these coins are typically volatile over a period of time. The biggest problem with cryptocurrency volatility is that there's no governing authority to regulate its prices. While there are regulatory bodies that govern other asset classes, there's no such authority for cryptocurrencies. Thus, the price of cryptocurrencies is consistently shifting, and investors are unable to control their investments. Because of this volatility, it's common and a very common feature for the cryptocurrencies. Despite the volatility, the market still presents a number of benefits for risk takers. Taxes in the US are likely if you're going to pay taxes on cryptocurrency gains. The answer depends on your individual circumstance. The capital gains rate will vary based on your income, but it's generally lower than 20%. In addition, you may be able to claim a deduction for your losses, your overall tax burden. But are you best avoiding paying taxes on cryptocurrency gains? Probably not. So let's go ahead and look into some of these tips so you can make the right decisions. The IRS has issued a notice stating that any cryptocurrency transaction is subject to taxation. According to the notice 2014-21, cryptocurrencies are considered property and subject to both capital gains and income taxes. This means that dividends and interest on them are taxed as ordinary income, while an increase in their value is treated as short-term capital gains. DeFi platforms use rewards to encourage users to deposit funds and hold them. AVES's programs, for example, offer a 2.95% interest rate for those who deposit and hold a USDC. If you sold cryptocurrencies for cash, the proceeds from that sale will be taxable. This is because cryptocurrencies is considered property and the IRS considers it as such when determining your taxable income. This means that the proceeds of mining a cryptocurrency are considered income for tax purposes. For example, if you sold a coin at $1,500, then the $500 profit would be taxable, while a loss of $500 would be tax deductible. The bottom line is buying and holding a cryptocurrency is not a taxable event.